Welcome back to Switzer on Australia's Business Channel. Chasing dividend-paying stocks has paid handsome dividends for at least 3 years, and surprisingly in the first 2 months of this year as well. But how long can this go on? And if this is becoming a so yesterday play, what is the next investment strategy we should be focused on? Michael Heffernan is from Phillip Capital, and he joins me at the desk. He's a doyen of broking. How are you, mate?
Yeah, great.
You once won the Broke of the Year, didn't you? Or did you win it a couple of times?
I did, yeah. I won it in 13 and came third last year, Peter.
Well, there you go. A doyen of broking.
No, it's very pleasing.
Too young to be a doyen, are you?
Exactly. You've got to keep your feet on the ground, and working in the market, Peter, can be one of the most humbling places to work.
What was that line the American DJ used to say? Keep your feet on the ground and reach for the stars.
Indeed. Exactly correct.
So,
yes.
Are we reaching for the stars, chasing dividends, paying stocks even now?
No, Peter, we're not. And the reason is that, you know, if we're talking about the good dividend stocks, your banks and Telstra, Wesfarmers, for example, they're the only ones that I put in at the moment. Wouldn't put Woolworths in that bracket just now.
Worrying a bit?
Yeah, it is a bit, for a number of reasons we'll go into later. But the thing about those ones is that they're potentially still good, Peter. Now, even if the banks, most of them, ANZ was not so flash yesterday, but the others, if they're growing at about 5% in their profit, as they are, they're paying 5% dividend, 42% franking. It's equivalent to about a 12% in a year. That's great. With interest rates at 2% around about, inflation hardly there at all, it's got to be a great investment, even if you say they've gone up a lot in the last couple of years.
If you were way over your holding of financials,
yes,
is it time to maybe think about coming back to the index, maybe taking only 42%, about 40 odd percent? If you're holding, say, 70% back, you know, you listen to people like you and me over the last few years, and they're like Richo. Richo's got 4 banks and Telstra.
Yes.
And he's got 80% exposure to the financial.
Yeah.
Is it time to pull back a little bit?
Well, Peter, as with all things, you've got to keep watching the market. Now, if there's a hesitation in their profit outlook, if something goes wrong with the stock, you have a look at it. But if things are going along okay, I don't think there's a need to sort of chop yourself off at the kneecaps and, you know, move on to something else without a reason other than the fact that they've gone up.
Okay.
I mean, I've said many times, I'd rather buy something going up than going nowhere. You've got to watch it. Now, Peter, I have my selling discipline as well. Now, if something drops 15% when the index is level, you look at it. That might be the signal for moving out of a bank, for example, if that happened. Now, that hasn't happened. So, look, the motto is, and I tell all my clients is, you've got to keep watching things, or you have a broker who can do it with you, such as from myself with the clients, for example, where you watch things, and if something goes wrong, make a change. But at the moment, Peter, you don't have to, unless the client wants to diversify a bit. They're getting a bit nervous about having so many banks in Telstra.
Okay. So even if we look at those sorts of stocks that have been very rewarding,
yes,
do you think there are some dividend stocks that people haven't gone long on because they're just not the popular ones, but still have a lot of good upside because they are consistent dividend payers?
Yes, well, let me put it this way. You've got your platinum circle of those stocks I'm talking about. Then you can move on to your gold circle ones. And
You're such an elitist, aren't you? Platinum, gold, silver.
Well,
okay.
There you go.
Let's go to the gold first.
We'll go to the gold. Well, there are some. Now, I think one that's a good one, but it's not fully franked, is Transurban.
Yeah, which Tom Elliott recommended last night.
Well, look, it's great. It's got the potential of, you know, it's a monster of the toll road the market in Australia.
Yeah.
It's got low oil prices, so people are using toll roads more. You've got a stock like Sydney Airport as well, is another dividend stock. Again, not fully franked, but still a great return. And the third leg of the T's is the Treasury Group. Now, the Treasury Group is a fund manager, owns some other boutique fund management, and Mike Fitzpatrick, the boss of the AFL, is the chairman of the Treasury Group. Yeah. Not that I'm a Carlton supporter, for those people who know anything about AFL football.
Mate, you don't have to be defensive. Because you're a Collingwood supporter.
No, I'm a Western Bulldogs man. No, the Treasury Group...
I was teasing them, but go on.
Yeah, Treasury Group, not too bad at all. Actually, that's one that I do recommend.
Explain to people what Treasury Group does. There used to be a sort of a trust group, weren't they?
They have, I think, Investors Mutual way back. I think Angelo Tagliaferri was involved with it then. A few others going right back to the 90s, I think it was, mid-90s when it started off. Yeah. But now it's got interest in a range of other boutique fund managers. Right. Now, I look at that, but I also look at their fundamentals, Peter. What their future growth is probably a key thing for me. A return on equity, I like to have it around about 15 to 20%. Low debt. P/E ratios don't worry me too much, although it's nice to have a lowish one. But if they're a good stock, you pay more for them. Yeah. Now, it's got all those sort of things in the fund management area with interest in other fund managers. Right. Now, that's a good one as well. Another one that's come up, look, I'll throw in Wesfarmers. I know Wesfarmers in the blue chip, but that is one I think that looks all right. Another one, ASX. Now, that is not one that's been on my favourite list for many, many years. Look, I just looked at it the other day. It's over $40, I think, now, paying around about 4 to 5% dividend yield. If you have the view that the market's going to do reasonably well this year, it certainly has, has hit its straps in the first 2 months. So that looks all right as well. There's no AMP now. AMP and ASX are not really on my top preferred list. You can't go past the platinum group for dividends. Okay. But these are in the gold, sir. Okay, so we can still play the dividend game. But also we know there's been a lot of good companies, cyclical type companies like Toll, that have been ignored for a long time while everyone chased dividends. Are there some cyclical type companies out there that you like that eventually a lot of these companies will do well before we get to the end of this cycle? Yes. Can you name some of those? One that's always been a favourite of mine for many years, it's fallen off the tree over the last years, Flight Centre. Okay. Now, Flight Centre got up to $55 or thereabouts a couple of months ago. Its reports weren't that flash, dropped down. I think it's now in the mid-30s now, $30 range. I think Flight Centre is good. I mean, with low oil prices, that should help airline prices. It should. I don't know whether it is, but well, I think Qantas's share price is a reflection of that, and Virgin as well. We've got John Bulgari on the show tomorrow. Qantas, I think, has got a lot going for it. You said one of the ones who've been overlooked in the past. Qantas hasn't been in recent times, but Qantas is one I'd certainly give a tick to. Don't go for dividends, but with low oil prices, not much competition with Virgin. These are sort of things. The clearing of the decks that happened a couple of months ago. I think Qantas are looking very good indeed, actually. So that's one as well. I think I mentioned one that as far as the silver circle of the dividends concerned, that was the ASX. Now, that one that has been overlooked, but it has come up a little bit now. I would certainly say that could be one of the orphan stocks as well that hasn't done well. What I found, Peter, in when people ask me questions like you've just asked me now. I try to ask normal people questions. We have normal people watching the show, mate. But go on. Yeah, very good. No, I didn't mean it in that way. But they say, well, what's a good thing this year? They tend to ask me that. Like going to the races, what's a good thing? Okay, right. Yes. But what you do, you look at the worst performers last year. In a lot of cases, they tend to be the best performers in the next year. So that's one thing that you can look at. They're really wild cards, those ones. If something's been belted to hell and high water, if that's the right expression. Mike, how long do you reckon we've gotten with this market? You're comfortable being in the market this year? Oh, absolutely. Yeah. What about 2016? 2016, yes, as well. I mean, you've got to watch things all the time. Yeah, well, that's why people watch the show. Exactly, Peter, exactly. Now the interesting thing is we are still 17% lower than our 2007 high point, even now. One of the only major share markets in the world that is still failing to reach its high point in 07. And history says that you pass that before you go into another crash. Well, you will. And I think that's see, the thing that's going for us right now is that you could say we're sort of at the bottom as far as the economy is concerned. As far as Europe's concerned, they can only go up, in my view. Yeah. America has picked up and the trajectory is still there. Asia is, not as good as it used to be. So all that's you're at the low point in my view.
Yeah.
So we can only go. We can only go up. This is not 2006.
Okay,
but 2007. So I think we've got further to go, Peter. No worries.
Okay.
6,000 points. I think on the 17th of March.
Okay, mate.
2:30 in the afternoon.
Yeah, February or March?
Oh well, I'll get. No, it could be tomorrow. Actually.
Okay, mate.
Yeah, no, I did mean March, but it could be a lot earlier.
All right, mate. Coming up, we'll look at why Sydney University is investing $1.2 billion creating a landmark building and a major campus.